Hi, this is Randy Finney with the Right Side of the Chart, and today is Wednesday, August 16th, 2023. It's 12:36 p.m. Eastern Time. I wanted to get this video out because I think this is a good time to point out what I'm seeing and just to reiterate my thoughts. I know we took a leg down to new lows today. I actually was long already, and I added some more long. So I think we're going to bounce, and I'll show you why, and then down. So I've been making that pretty clear lately. You know, we've had these divergences, been unwaveringly bearish from the intermediate term perspective, looking for this leg down, and then also some more to come. I just still suspect we'll probably get a rally before then. I added to the post before that I got out to you this morning, but let me show you the levels if we do bounce. Now, if we don't, we don't, and then these divergences get burned through, and that's going to be very bearish. But I think it's a good time, right as I'm starting this video, to buy. We just hit a low for the day. I think that's probably sucked out the last of the weekend of longs, blew them out, shook them out, sucked in some more shorts, and I think we'll see I think, again, a nice rally. That's what I do. I share my opinion, right or wrong. There's the downtrend line I had this morning. I don't want to add it again here. That downtrend line needs to go on QQQ, obviously, to trigger even a more powerful sell signal. But you can see this is the divergence I was talking about. We have divergence on the 5-minute chart all the way out to the 60. Those are the pretty much my go-to swing trading intraday timeframes. Now, with all that being said, I've spent weeks now showing the bearish technical posture and levels to watch, and even bearish developments that have already now occurred on the more significant daily and weekly charts. So those are your cross currents, and the weekly charts will help me to formulate the bigger picture. So I still think there is more downside in the coming days to weeks. I'm sorry, more in the coming weeks to months. Now, it could come soon. If we can't rally here, I'll tell you what, and I've said it before, nothing is more bearish than a perfect, nice, strong, bullish setup, especially with the intermediate term trend, really since October of last year, still being bullish. And so this is still just a correction. And you have this positive divergence on the 60-minute chart. When we've had it from this point, we start to rally, and that's the thing. I've noticed that all these rallies are getting sold into, and so I pointed that out recently as a change of character. However, that's what happens often. It happened here. We had divergence there. We just kept building, getting bigger and bigger divergence, and then finally that third divergent high after the smaller corrections off the previous two played out for a bigger drop. So again, those are my thoughts. There's still support here, about 364 right there on QQQ. You can see the levels. These are previous lows right here. Still very much the divergence. You can walk it down to a 15-minute chart. You see the divergence. See, I just take these lines that I had here before, and we have a marginal new low. And so what happens is, since they took out the low, this is where, again, I've learned to think like the nefarious bots, or the algos in the market. And even goes back before that we had computerized trading and algorithmic trading programs. The old school market makers of yesteryear, they were the ones that could pull. They had the power to pull stocks down to clear stops. They called it a stop rate. So a lot of especially, I would say, retail traders probably have their stops just below these two previous reaction lows, and that was hit. So what happens is, those stops are cleared, and again, that shake takes out, when I say weak-handed longs, just hot money that's in the market, easy to sell, easy to shake out, because if you didn't stop out, then you have, longs that will ride this thing out, like the kind that'll ride out 30-40% drops. They stay in there, and you have just a better subset of holders. Plus, if you can suck in some shorts, even on a day trade or short term, and we start to reverse up here, then those shorts cover, and that short covering is buying. That's what you do when you close a short position. You buy the stock, you buy to cover your position that you didn't technically own. You were borrowing shares from your broker, which is coming from someone else. They lend you their shares, and then you buy to cover, and that creates buying pressure. And so this is what I can see happening today, and I'm leaning towards still. And so just a little bit better opportunity. It's aggressive counter trend, because we are in a near-term downtrend. Make no mistake about it. We've been zigzagging lower, but that's what I do. If you follow me for a while, most of my trades, a lot of them, not all of them, but a lot are counter trend trades. I will take continuation pattern breakouts that are, aligned with the trend, but quite often I like to catch tops and bottoms, i.e. trend changes. And so that's where I think we're going here. So run up. The first significant resistance level will be that downtrend line. We have a comparable one on SPY, a break above that. And again, let me give you my target ranges. Minimum target right here, 372. In a really good level. I think the buyers will probably, sellers will step in there, get a reaction with the potential that we could move up here, 375.40, and then I had that downtrend line off the high. They all come in together. It's not a very big range. What I'm giving you, if you extend that downtrend line out like I just did here, or extend it out here, then they all come in together. So I'm going to do it one more time for you. I'm going to box that range. It goes from about here down to about right there. And you can see, if and when we get there. Now, we could do this. We could crap out and then forget about everything I'm doing now. It's just a what if scenario. But that's what my job is to get these, scenarios and key levels out to you in advance so then you can act upon them. If you so choose, whether you are bearish and you're looking to short a rally, or you're bullish and you're looking to buy dips, and then you're looking to also buy, here's a dip you can buy with divergence and support levels and all that stuff we're at now. And you can also buy breakouts above these same resistance levels, because that would be bullish. If we go up here much beyond that, sure, there's a couple resistance levels, still left. You can see them marked on my chart, but breakout above that trend line probably would be bullish, and in my opinion has a good chance of taking us to taking out the previous highs in the Nasdaq 100. So there it is, guys. I'm looking for a near-term bounce, position that way, and we'll flip on a dime because let me get to the longer-term charts and show you levels I'm watching. QQQ, turn off all the lines. This is the daily chart. I pointed this out a few days ago. First expect to bounce on the and they did. I said it would be unusual to not see the algos and humans as well step in and buy the first pullback to the 50 in a long time. It's been a lot of people that had that FOMO thing going on, fear of missing out, and were upset they missed this rally, and they've been looking to buy a dip. And so if you don't buy a pullback to the 50, when do you buy? If you don't, if you're a dip buyer. So, and they did. And, we had a couple pops off it. And again, I've been in active trading mode. I keep giving you 5-minute charts, every now and then 15-minute charts. And, you had a good, 1.5, nothing big. But here's the point. We've been hugging that 50-day for the last 4 sessions. Look at that. That's the yellow line there. Boom, 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 boom. I mean, right on it. We are below it now. So this is, technically, that's a breakdown and that's bearish, right? However, if we recover it, as I just mentioned, that has the potential to be a whipsaw, bear trap, whatever you want to call it. And then you would have, especially if you can see QQQ solidly get back above that level, then you'll probably see some short covering, especially for those shorts that jumped in late, what I call JCL, or Johnny Come Lately shorts. They didn't want to short when we were shorting back here on the break of this wedge and this divergent eye. They didn't want to short, on the bounce backs to resistance or the break of that support level. But now after the, Nasdaq's had its biggest drop in months, they want to short now. Those are the ones I call Johnny Come Lately shorts. And those tend to be the same like the the ones that want to go long here and here and here, but they didn't want to go long back in January, when we were going long the Qs and overweighting big tech stocks and all that stuff. So anywho, that's how it tends to work. And I may spend 15 minutes wasting my breath on showing you these scenarios that may never pan out. So all I can tell you is be adaptive. And flexible if you are an active trader. And if you are a longer term trend trader, I've said this time and time again, I still believe, I may be wrong, but I still believe we're going much, much lower. Probably even going to take out the previous lows from October of last year. So we're talking well into double digits is what I believe is the most likely scenario. And you could, if you got in, if you have a decent entry on shorts, or you're looking to add to shorts, then don't worry about gaming. Well, again, if you want to add, then you want to look for rallies into resistance or breaks of support. So to be clear, those are the two objective ways to short a stock, either on a break of support. But what you don't do is short a pullback to support. Longs, you do one of two things when a stock pulls back to support. If you're bullish and you think the stock's going to bounce, whether it's a short-term bounce you want to game as an active trader, or the continuation of the previous bullish trend, you step in and buy. You buy a pullback to support. If you think that support is likely to break soon without much of a reaction, then you wait for it to break before entering a short position. So shorts will either short on a break of support or a bounce back, a rally into resistance. So think of dip buying in reverse. You just have to think like a bull in reverse, where bulls buy pullbacks to support and they buy breakouts above resistance. Bears will short the breakdowns of support and they will short the rallies into resistance, but then have stops just above it, right? Okay, simple stuff. And let's just look at a few other things. So there's that. I already showed you the 50-day we've been hugging. Let's look at the S&P 500 because that does matter. Here's the primary trend line. So the S&P, and again, this is why you can't get crazy. In my opinion, it's not time to be aggressively long or short as an active trader. We had some sell signals recently I've been waiting for a long time, like Apple and all that. Things that I did a few weeks ago say that's when you can get more aggressively short. So from a trend, longer term position, yeah, I think it's okay to be pretty aggressively short here. I'm just trying to micromanage and show you, if you plan to add to short positions, what you need to see. Again, breaks of support, recent lows. Love to see those divergences burned through or taken out, whether we get a bounce first or not. That would be another reason to increase some long-term short exposure. But here's SPY. So on this 60-minute chart, we're right at the trend line, a hair below it, and you still have, take these lines, you still very much have the positive divergence in place. And as I say, it is not a guarantee of a rally, but much more often than not, you do rally off those. And it could be a substantial rally, at least, for an active trader, about 451.50. You see I have first resistance about 448.20, and then up here. So it's called about 451 to 453 would be, at this point in time, my maximum bounce target zone. Let me add that trend line I had for you this morning when I got the charts out. So there's another downtrend line as well. So that's what SPY looks like on the 60-minute chart. But when we go to the daily chart, and this is important to note, okay, remember I told you I'm using the 50-day exponential moving average as my yellow line. Some traders will look at the simple. I usually will have them both up. For example, I have both the 200 exponential in red and the 200 simple in blue. And again, you can add it, but this is the one I prefer, the 50 exponential. And so you can see the S&P hit it yesterday perfectly at the lows, I think, are all close enough to being perfect. That little skinny part on the bottom. And we're right on it right now. Okay, so what I'm just showed you is both the Nasdaq 100 and the S&P 500 have corrected back to their 50-day moving averages, exponential moving averages for the first time. The last time we had a correction to it, and they did what they do, they stepped in and bought, was right here. That's May 24th, right? And then the time before that was right there. And there's a good example of an intraday pierce. Suck in some shorts, shake out some longs, only to reverse and boom, and rally from there. There was a near perfect tag of it. And this is when we took it back earlier in the year. We danced around and through it for a while. But since then, again, when you get in a choppy market, you're going to chop a sideways a market that's not trending up or down, just kind of moving around like we had earlier in the year. You tend to chop through your moving averages. Once you start trending, a clear uptrend, which this has been, that's when it tends to act as good support. Likewise, once you break that trend, the trend reverses, and you have a clear downtrend, you want to short rallies back to the 50s. So that's it. We're at the 50s. Maybe they hold, maybe they don't historically, and you can see at least, especially all throughout most of the year, going back to at least to April here, when you had pullbacks to the 50, they bought it and the rally resumed. So again, I'm not looking for new highs right now. I'm open to all possibilities for many reasons I've covered before. I think we're just looking at a reflexive bounce that an active trader can game, and then close those longs out and either sit back and wait for your next objective setup if it plans out, or add reverse back to shorts. And then again, all this talk, maybe we don't hold it. If we smash through these 50s, that is another support level going. And it tells me, wow, the supply demand dynamics have really, really shifted. All the buyers have now left the building if they don't step in and buy it here. And we might be looking at a much more powerful downtrend that doesn't have a counter trend rally at this point. Right now, if you look at it from the daily, we've had these little zigs and zags, but I wouldn't consider any of these really a counter trend rally yet. That's what a counter trend rally would look like, more like that. There's a counter trend move and an uptrend, which was a correction, another counter trend move, and resumption of the trend. Okay, so that's it. This is what I think is going to happen. We'll see. Every day I try to look at the charts with clean, fresh eyes, try to see what I missed, and if my view changes, I'll let you know as soon as it does. Okay, you remember a few months back, a few weeks ago, I do this all the time. Every now and then when I think it's relevant, I will have I'll cover the euro, tell you where I think the euro and the dollar. I look at EUR/USD, which is really the euro, US dollar pair. Look at the dollar index, or just the pure euro and euro futures, that is. And it's pretty much any currency is really just based on, the US dollar index is a basket of currencies, and the euro is the largest by far, and there represents, I think it's 57.6%. Don't hold me to that, roughly, of the dollar index. Oh, there it is, 57.6. And then the yen is a distant second, and then everything else really doesn't even matter. Even the pound, it doesn't even really add up. Or move the needle, if you will, because of the huge weighting here. So looking at the euro is like looking at the dollar in reverse. And so, I've shared this. We put in this divergent high, and I was bearish on the euro, which was bearish on gold and silver back here. Told you that probably correct off that, go down, and the stock market would correct. So this all aligned with this current pullback in the market we've had, and the reason for being short the semis and in tech, big tech, and QQQ and things like that, because of that pullback. Now, we did just break down on the wedge too. That's bearish. So just like the stock market, I think we're going to continue to see this fall. However, I could see a back test here before we do fall. That would align with the stock market bounce. That pair trades around the clock when you look at that chart. So if you want to just see the euro, how it trades during regular trading hours in the U.S., 9:30 a.m. to 4 o'clock p.m. Eastern time, then you want to pull up FXE, which is the ETF or ETN that tracks the euro. And it's an identical chart, but again, this is better when you want to compare, which I'll do right now for you. And you can see the same thing if you want to compare it to the stock market, that is. So divergent high 1, and again, this is what I talk about. It's not as if these divergences don't work. They usually do play out, not always, but usually, and that one certainly has played out. Question is it going to continue to play out for more? I think so. But here's that comparison I've showed you in the past, including recently when we were right up here expecting the drop in the euro, which was also the case to short the stock market. And what we do here is we just turn them on. There's QQQ, and here's SPY. Let's make SPY a different color so it stands out. And you can see, so if you don't take my word for it, and again, I've showed you this hundreds of times over the years and quite a bit recently, because there's a very, very strong positive correlation between the euro and the stock market, which is the same as an inverse correlation to the US dollar. See, I can show you the dollar, but then everything is upside down. I'll show you that in a second. But so make no mistake about it. It is not mere random coincidence that the euro and the dollar both peaked here in the stock market, and they've been falling. So I'm going to keep an eye on the euro. I'm going to show you right now where, what the charts are saying. And so that's that. So make no mistake about it. There's a super strong correlation there. Again, if you want to look at the dollar, you go to UUP, and then everything is now upside down. So this is the S&P 500 and QQQ here going down while the dollar went up. But you can also do UDN, which is the inverse of the dollar. That's the short or bearish US dollar index fund. And it mirrors, the euro, and same thing. You can see both of them falling, both of them going up here, going up since this point, really, even that little correction in between. So All right, and so let's turn these lines off, and here, let me just jump over to the 60-minute chart and show you what the euro looks like. And see, EUR, USD. Yeah, so this is what it looks like on the 60, just like the stock market. And also, not by mere coincidence, we just put in a divergent low on the 60-minute time frame. And here's your divergence lines. We've been diverging right here. You can see since this point right there on the PPO and all the way back here, really, since the on the RSI. And there's a little minor downtrend line, and just like that one I just gave you on SPY and QQQ today, we could probably look at this one here. So that's what you want to see to go. If you want to be a little more cautious, I tend to be, quite often an aggressive trader. I'll take breakouts before they even happen, or position for them before they happen in anticipation that they will happen. But I usually take a starter position, then add to my position if it does happen, or stop out if it doesn't, if we keep going lower. But that's a level I think will spark a rally here, and or has the potential to. But the selling pressure in the stock market's been strong, and you can see the euro, we've had we had a divergent low right here, and we got a rally out of it. It's not as if it didn't rally. But this one, so far, the buyers just aren't stepping in yet. But if they do, again, the aggressive ways, maybe cover some shorts here. Or look, I know I speak to a lot of different trading styles and time frames. If you've been short the equity markets and you want to hold those shorts because they're profitable, you don't want to get shaken out of them, at least set your stops. If you're short QQQ, for example, or SOXX or XLF, which I mentioned, XLK, I'm sorry, the tech ETF. You can tighten up stops. One level, a good stop would be above this trend line that I just showed you earlier. That's one certainly, because if we come up, that means this whole thing will be a false breakdown, whipsaw. Probably going to see some buyers step in. And so you could lower stops to protect profits if you think we're going down, or you can take a starter long position here, adding if and when that breaks out. And again, targeting minimum target right here, this resistance zone, second target, which would probably come in again roughly together if it plays out that way, because it's not going to be you don't go straight up. So I need to extend this line out, and again, just try to give you my best guesstimate of how breakout, hit that, maybe consolidate, pull back, and then maybe another thrust up that comes in with this 375.40 and downtrend line, so this is again my max target zone, or max target right there. The trend line and the 375.40 probably come in around together at the same time if we get there. So minimum right there, and max. It's not much of a range. It's a pretty tight range. I mean, that's what I call micro calls. They're sometimes difficult. Sometimes I'm surprised how easy they work out. So, all right. And then to measure it for you, somebody asked the other day, hey, when you say, looking at a small value, can you tell me what that means? So I'm trying to give you percentages. I usually do 2% to the minimum target there, about little shy of 372, and a max bounce target potential of about 3%. So we're not talking a big window. And it doesn't mean we can't go further. Again, if you do reverse there, if we get there, I'll probably be reversing at this point from long to short, and I may even do it here. Depends on what happens, and even as an active trader, I probably will. I like to play those minor squiggles. But then if you do, then, you can have a stop right above there. Now, not, give it somewhat. They like to, again, the powers that be, whatever you want to call them, they know where the stops are. I mean, heck, they buy that data from the exchanges. It's there on the exchanges. You send an order to your broker. Interactive brokers, they do have an option. I love to toggle it. You can hide your orders. I love to hide my orders. In other words, they don't send it to the exchange. They don't send that order until right when it needs to go. If it's a limit order to, let's say a stop loss order here at 376.90, right there where my crosshairs are, it'll sit there hidden. And but then if the stock, if I am short and I have a stop loss at 376.90 and that price is hit, then it'll boom, fire my order off right away, and I'll get stopped out. But it helps, again, I just don't want my orders seen, especially my stop loss orders. I don't hide my profit targets. If I'm, if I'm going to be targeting this move up to here, and then plan to sell in reverse, I want my order seen. I want it filled. I want them come get it. Fill my profit order, my sell limit order for booking profits on a long, that is, because my goal on every trade is to not get stopped out, but to have my profit target filled. So hopefully that makes sense. I could sit here and look at 10 different other iterations of these charts. I can show you the stock futures. They're going to show you the same thing. Divergent lows on the 5, 15, 60-minute charts. And most importantly, the two most important indexes to me, the S&P 500 and the Nasdaq 100, both on their 50-day moving averages. To say any more, I'll just be redundant and beating a dead horse here. And again, it works the other way too. If I'm wrong and those averages don't hold, that's going to be bearish. So don't get married to any one thing that the market must do. But I think, I think the odds right now favor a tradable bounce. And I quantified what tradable means to you. And 2-3%, something like that. All right, guys, I'm going to wrap it up here and get the video out to you. And if anything big changes by the end of the day, I'll update it. Still not excited on a lot of other things out there. I think that crude short has more to play out. We hit our first target yesterday and had a reaction so far. But again, I don't want to get into all the other stuff. I'm trying to keep these videos capped, ideally under 30 minutes. If I could make them in 20, that would be great. So I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.